Welcome and thank you for joining us today for our lunch presentation. Hopefully everybody has something to eat with them. We always want to keep you updated and present best practices. So today we are doing our countdown to top essential tax and financial planning tips for individuals and businesses. Today's presentation will review many important reminders and updates on both individual and business tax considerations as we end 2024 and start 2025. Hopefully everybody has some fun New Year's plans. You will hear from several of our experts on things to consider and be aware of. We'll save time at the end for questions and have a live session for that. Before we get started, I'm going to do some quick housekeeping. If you're regular to our webinars, you know all about this. I'm Carolyn Powell, Development Director here at Tronconi, Seguera & Associates, and I'm going to be your host today. Now, on the right side of your computer, you should have a toolbar, and in there you will be able to get, in the handout section, a copy of the bios of our presenters today. And also, too, you should see a question section that is where you can pop in your questions for our experts, and we'll get them answered in the end. At the end of today's presentation, you'll also receive an email with a link to a survey. If you could please just complete it, let us know how we did. If you had any questions for our experts, you can also put that in there if you'd like to set up a meeting with Kevin or Lisa. You can note that in the survey as well. And we would love to get your feedback. At the end of today or tomorrow, I will personally send you an email with a copy of the recorded session, a link to that, and the slides, so that if you want to share with somebody else or go back to something, you can do that. So without further ado, let's get started today. Tronconi, Seguera & Associates is a certified public accounting and business consulting firm. Lisa Mrkall is with us, and she is a CPA and partner here at the firm with almost 10 years working in our small business department with business clients and individuals. Kevin Carrigan is a supervising senior at the firm and has over 7 years in public accounting and specializes in tax. Lisa, you want to get us started today?
Absolutely. Hi, everyone. Good afternoon, and thank you again for joining us today during this very busy week before the holidays. Again, my name is Lisa Mrkall, and I'm a partner in the small business department here at Tronconi, Seguera & Associates.
And I'm Kevin Carrigan. I am supervising senior here in our tax department at Tronconi, Seguera & Associates.
So it's our pleasure today to kick off our countdown, which will highlight 10 important tax and financial planning matters we believe are key to hearing about as we near the end of the year and enter into tax time. With the sunsetting of the Tax Cuts and Jobs Act of 2017, for example, change is inevitable in 2025 and in 2026, and uncertainty does remain high. So our topics today will reflect what we know right now and how to best plan for a successful tax preparation experience for you, your family, and your business. So let's get on to our countdown.
Hello, my name is Karen Belzile. I'm a senior manager in the small business department with more than 25 years of audit and tax experience. Before we look at the key changes for the tax year 2025, I want to note that the due date for the 2024 Form 1040 will be April 15th, 2025. This year's deadline will not be impacted by Emancipation Day in DC or Patriots Day in Maine and Massachusetts. The IRS has released its inflation adjustments for the tax year 2025. The details are outlined in Revenue Procedure 2024-40, but here are some of the important adjustments that you want to be aware of. The standard deduction for single taxpayers and married individuals filing separately for the tax year 2025. The standard deduction rises to $15,000 for 2025, an increase of $400 from 2024. For married couples filing jointly, the standard deduction rises to $30,000, an increase of $800 from tax year 2024. For head of households, the standard deduction will be $22,500 for the tax year 2025, an increase of $600 from the amount for tax year 2024. Marginal tax rates. For tax year 2025, the top tax rate remains 37% for individual single taxpayers with incomes greater than $626,350. For married couples filing jointly, that's $751,600. The other tax rates are 35% for incomes over $250,525. For married couples filing jointly, $501,050. 32% for incomes over $197,300. For married couples filing jointly, $394,600. 24% for incomes over $103,350. For married couples filing jointly, $206,700. 22% for incomes over $48,475. For married couples filing jointly, $96,950. 12% for incomes over $11,925. For married couples filing jointly, $23,850. And 10% for incomes $11,925 or less for married couples filing jointly, $23,850. Alternative minimum tax exemption amounts. For tax year 2025, the exemption amount for unmarried individuals increases to $88,100. For married individuals filing separately, $68,650, and begins to phase out at $626,350. For married couples filing jointly, the exemption amount increases to $137,000 and begins to phase out at $1,252,700. Earned income tax credits. For qualifying taxpayers who have 3 or more qualifying children, the tax year 2025 maximum earned income tax credit amount is $8,046. The revenue procedure contains a table providing maximum EITC amounts for other categories, income thresholds, and phase-outs. Qualified transportation fringe benefit. For tax year 2025, the monthly limitation for the qualified transportation fringe benefit and the monthly limitation for qualified parking rises to $325. Health flexible spending cafeteria plans. For the taxable years beginning in 2025, the dollar limitation for employee salary reductions for the contributions to health flexible spending arrangements rises to $3,300. For cafeteria plans that permit the carryover of unused amounts, the maximum carryover amount rises to $660. Medical savings accounts. For tax year 2025, participants who have self-only coverage, the plan must have an annual deductible that's not less than $2,850, but not more than $4,300. The maximum out-of-pocket expense amount rises to $5,700. The family coverage in tax year 2025, the annual deductible is not less than $5,700. However, the deductible cannot be more than $8,550. For family coverage, the out-of-pocket expense limit is $10,500 for tax year 2025. Foreign income exclusion. For tax year 2025, the foreign earned income exclusion increases to $130,000. Estate tax credits. Estates of descendants who died during 2025 have a basic exclusion amount of $13,990,000. Later in our webinar, Lisa will be providing important information about changes that may come into effect after 2025. Annual exclusion for gifts increases to $19,000 for calendar year 2025. Adoption credits. For tax year 2025, the maximum credit allowed for an adoption of a child with special needs is the amount of qualified adoption expenses up to $17,280. Thank you.
Hello, my name is Carrigan, and I am a tax supervising senior here with more than 10 years of business tax experience. Some key future due dates that you should be aware of for your business tax filings include the following. 2024 partnership and S corporation tax returns due on March 17, 2025. 2024 C corporation tax returns due on April 15, 2025. And lastly, 2024 exempt organization tax returns will be due on May 15 of 2025. Each year, the IRS allows annual inflation increases on specific items relating to your business. Here are some important inflation adjustments that you will need to be aware of for your upcoming filings, which also will be briefly touched upon later on in this webinar. Mrkall Accounting methods. Small businesses with under $31 million in annual gross receipts in 2025 or $30 million in 2024 will be allowed to avoid specific accounting methods which would otherwise be required by the IRC in most cases. This includes the following: accrual method of accounting, capitalizing specific inventory costs under Section 263A, and lastly, business interest expense limitations under Section 163J. Next, the famous Section 179 deduction. This deduction will be limited to $1,250,000 in 2025, which is an increase from 2024 when it was limited to $1,220,000. Lastly, Section 461 loss limits. Losses from businesses in aggregate of more than $626,000 for joint filers and more than $313,000 for all other non-C corporation filers will be suspended and will need to be carried forward on Form 1040s in future tax years. Finally, some other updates for business owners to be aware of. Bonus depreciation. This threshold for allowable bonus depreciation has been limited to 60% only in 2024 and 40% in 2025. The remaining adjusted basis of your fixed asset placed in service for those years will need to be depreciated over the life of the asset. Lastly, Section 174 capitalization. Research and development costs still need to be capitalized and amortized for the time being. There is no official legislation made by Congress yet that removes or has suspended the capitalization for 2024 or 2025 for these costs.
Hi, this is Lisa Mrkall. I'm a partner in the Small Business Department, and I'll be kicking off today's countdown with a discussion about education planning and the new FAFSA. The 2025-2026 FAFSA form is now available for all students and contributors. Complete the form to apply for financial aid for college, career school, or graduate school. As many of you may recall, the FAFSA was overhauled before its release last year, and because of the extensive changes, was delayed well into December of last year. So the FAFSA just opened in November, and submitting the form is required for all students to access federal Pell Grants, student loans, and other kinds of financial aid, and is filled out by millions of people annually. In addition to the benefits of the federal student aid and loans, a 529 plan considerably help families combat the rising costs of a college education. Given the rising costs, it is essential for families to plan ahead. One of the most effective ways to do this is by investing in a 529 plan, which is a tax advantage savings plan designed to encourage saving for future education expenses. 529 plans offer tax advantages, flexibility, options for control, and ownership, and can have a low impact on financial aid. Automatic contributions from your bank account also make it easier for families to consistently save over time. Even small regular contributions can add up significantly over the years. To make the most of a 529 plan, parents should consider the following strategies. Number one, start early. The earlier you start saving, the more your investments have time to grow. Even small contributions made when a child is young can accumulate to a substantial amount by the time they're ready for college. Make regular contributions. Consistency is key when it comes to saving. Setting up those automatic contributions ensures that you're regularly adding to the account, helping to build those savings over time. Taking advantage of state tax benefits, number three. So be sure to explore the tax benefits offered by your state, contributing to a 529. We can certainly help you with that. These benefits can include tax deductions or credits, which can provide immediate tax savings. Number four, invest in low-cost options. Many 529 plans offer a range of investment options, including low-cost index funds. And by choosing these low-cost options, you can maximize the growth of your savings while minimizing fees. Number five, monitor and adjust. As with any investment, it's important to regularly review your 529 plan and make adjustments as needed, whether that be to investment options or the beneficiary. This might also include rebalancing the portfolio, your contributions as your financial situation changes. So 529 plans can also be a powerful estate tool. One of the unique features of these plans is their ability to accept large lump sum contributions without incurring gift taxes. The IRS allows individuals to have 5 years worth of gifts in a single year, up to $90,000 per donor $180,000 for married couples per beneficiary as of 2024 without triggering gift tax. This super funding provision makes 529 plans an attractive option for grandparents who wish to reduce their taxable estate while contributing significantly to their grandchildren's education.
Hi, my name is Viviana Speller. I'm a senior in the tax department at Tranquility Secure Associates. Today we're going to be talking about payments in virtual currency and the IRS report. On your tax return, there's going to be a question asking if any time during the year did you receive seller exchange of a digital asset. In order to check this answer as no, you would have had to not own it, digital assets, have owned digital assets and not sold them, or purchased digital assets but did not sell them. In order to mark this question yes, you must have received digital assets in exchange for goods or services. You sold or exchanged any digital assets. If you exchange one digital asset for another, that would be considered a sale, and that would have to be reported on the return. The transaction is going to have to be reported regardless of a gain or loss being recognized. So even if you sell it for the same price that you purchased it for, that transaction is still going to have to be reported on. Depending on the character of the digital asset and why you're holding it, it's going to depend on how it is taxed. If you are holding it for investment purposes, it's going to be treated as a capital asset, and you will have to report that similar to how you would for the sale of stock. If you are holding those digital assets in a business context, and that you received or sold those in exchange for goods or services, or in the ordinary course of business, that would be taxed as ordinary income, and that would likely be shown on Schedule C.
Hello, my name is Melissa Wasuko, and I'm a principal in the Small Business Department. As we approach year end, we start to think about tax planning. It is important to consider planning not just for the short term, but looking to the future as well. Looking ahead to the end of 2025, provisions of the Tax Cuts and Jobs Act, TCJA for short, will expire. I'm going to briefly go over some of the impacts to individual tax returns. One change that will impact all individual returns are the tax brackets. Under the TCJA, the highest tax rate was 37%, and that will increase to 39.6% for 2026 if the TCJA sunsets. Another change will be to the child tax credit. Not only will it decrease from $2,000 per child to $1,000 per child, but the AGI limit to claim the credit will also decrease from $400,000 to $110,000. As a result, less individuals will be claiming. There will also be changes to the standard deduction. For the filing status married filing joint, standard deduction will decrease from $29,200 in 2024 to $16,000 in 2026. This will partially be offset by the personal exemptions that will go back into effect in 2026. Currently, there are no personal exemptions for individuals. In 2026, the exemption will be approximately $5,300 for each individual, spouse, and dependent. If you itemize your deductions, the change with the biggest impact will be the removal of the SALT limitation. SALT is the state and local tax deduction, which is currently limited to $10,000+. With the sunset of the TCJA, there is no limit to the amount moving included in itemized deductions. As these changes are only a short year away, please reach out to your tax professional to see how they will impact your personal taxes and what you can do to plan ahead.
Hi everyone, my name is Stefan Slider and I'm a principal in our tax department. I will be going over the major sunsetting provisions of the Tax Cuts and Jobs. I'll start with bonus depreciation. This is an additional immediate depreciation on qualified fixed asset purposes. The TCJA implemented 100% bonus depreciation, phasing down by 20% per tax year starting in 2023. Currently, the bonus depreciation rate is 60% for 2024, phasing down by 20% per tax year through 2026, in which it will be zero afterwards. Tying into bonus depreciation is Section 179 expense. This is immediate expensing of qualified fixed asset purchases. The TCJA increased the deduction limitation to $1 million, increasing for inflation on a yearly basis. This provision was made permanent. It is not going away. However, unlike bonus depreciation, there are taxable income limitations as well as placed in service phase outs when claiming the expense. Next up is the excess business loss limitation. This limitation applies to partners, shareholders, and self-employed business owners. Net trade or business losses in excess of yearly thresholds adjusted for inflation yearly are disallowed and carried forward as a net operating loss, subject to an 80% taxable income. This provision was set to expire on December 31st, 2025. However, it has been extended through December 31st, 2028. The next sunsetting provision are opportunity zone investments. These are investments that were created as an economic development tool that allows people to invest in qualified distressed areas. Investors have the opportunity to take advantage of investing qualified capital gains into these investments and receiving tax deferral treatment on the capital gains invested. The opportunity for capital gain deferral expires on December 31st, 2026. Finally, the last major expiring TCJA provision is the qualified business deduction. This deduction is available for partners, shareholders, and self-employed business owners. It's a deduction of 20% of qualified business income, generally pass-through income and self-employed business income. This deduction is limited by the owner's taxable income, whether the business is labeled as a specified trade or business, and by wages and capital investment of the business activity. This deduction is set to sunset on December 31st, 2025, increasing the effective tax rate on qualified business income by approximately 9%. It is to be determined if this is going to be extended with the new presidential regime taking over for the next year. So we'll keep you posted.
Hi, this is Lisa again from the Small Business Department. And my topic here will be estate and gift tax planning before the tax laws sunset. As we enter 2025, financial and legal communities are abuzz with discussions about the imminent sunset of the 2017 Tax Cuts and Jobs Act. For many, this translates to pressing changes affecting their estate plans. Understanding the impending changes, so the 2017 Tax Cuts and Jobs Act introduced favorable estate tax provisions, offering a hefty federal estate tax exemption of $12.92 million per person. However, by January 1st of 2026, this exemption is set to drop significantly to roughly half its current value adjusted for inflation. Why immediate action is essential. Estate planning is not a process to be hurried. Comprehensive strategies, especially ones revolving around gifting to trusts or establishing gifted vehicles, demand time. Here's why immediate action is crucial. There is a short planning window. There's only about 1 year left in which the estate planning realm, which is the blink of an eye. Estate planning attorneys are facing a surge in demand and may stop accepting new clients long before the deadline, leaving procrastinators in a pinch. By acting now, you'll make the most of the current exemption before it reduces, potentially saving significant tax dollars. Steps clients should take immediately. If you haven't already, now is the time to meet with your advisor. They can provide insights tailored to your unique financial situation. Review your current estate plan. Be sure to understand the implications of the looming changes on your estate plan. A periodic review is always advised, but now it's non-negotiable. Engage an estate planning attorney. Given the anticipated demand surge, seek out and engage a reputable estate planning attorney sooner than later. And stay updated. As we inch closer to 2026, there might be new legislative changes, court rulings, or other factors impacting the estate plan.
Hello, my name is Anne-Marie Michalowski, and I'm an accounting services manager in the Small Business Department. And today I will be speaking about preparing your business for tax time. With another tax season fast approaching, now is the perfect time to look at your books and records to determine what needs to be done to prepare for year end. Consider the following. Is your general ledger up to date? Are your cash accounts reconciled? Hopefully your answer is yes. But if not, begin going through your general ledger and compare it to your monthly bank transactions. Make sure all of the checks issued throughout the year have cleared. all customer invoices created have been paid and deposited, and that your general ledger matches the bank statement, with the exception, of course, of any outstanding transactions. Make it a best practice to identify and correct any discrepancies throughout the year to minimize the time spent at year end. Are all your transactions categorized correctly? If, for instance, you collect sales tax, be sure to record this part of the transaction to a sales tax liability account rather than a revenue account. If you have employee payroll, differentiate between the wage portion and the employer's share of payroll taxes. These expenses should be recorded in separate general ledger accounts so that your accountant can easily identify them for reconciliation purposes as well as tax presentation purposes. Are you able to properly substantiate your deductions? To claim a deduction, you must be able to substantiate the expense with supporting documents such as an invoice or a receipt. Proper record keeping is essential throughout the year so that information is readily available upon request from your accountant or auditor. A bit of tax preparation this time of year could go a long way in making the upcoming tax season a little easier and a little less daunting. So good luck and happy holidays.
My name is Jenna Taylor, and I'm a supervising senior in the tax department. Here are 6 wise ways to use your tax refund. Build your emergency fund. It is suggested to have a fund of at least 3 to 6 months worth of expenses saved. A normal savings account can suffice, but if you do not need the money immediately, a certificate of deposit, otherwise known as a CD account, is a great option. Contributing to your retirement account is a good way to build for your future. Consider contributing part of your refund to either a Roth or an individual retirement account. Credit card debt is considered bad debt because it isn't used to pay for any appreciating assets. It is highly encouraged to pay off any credit card debt due to the high interest rates with your credit card company. Putting extra funds towards education can help yourself or your children, as it is an investment in human capital, not to mention the potential tax benefits you may be able to take advantage of with future tax returns. If you're thinking about moving in the future, increasing your home value with some renovation projects using your refund is also a great idea. If you're not planning on selling anytime soon, renovations are also linked to improve your family's overall quality of life. Last but not least, giving to a cause that is close to you is emotionally rewarding. There are also added possibilities of tax benefits depending on how you choose to give. Make sure you keep your receipts if you do itemize on your tax returns.
This is Lisa Mrkall. I'm a partner in the Small Business Department here at TSA, and I'm going to be talking about understanding capital gains tax and some tax planning issues associated with capital gains. So keeping in mind, it's not just about how much money you make, but how much you keep. Capital gains taxes might sound like a complex financial term reserved for the wealthy, but in reality, they touch most investors and many homeowners. Whether you're selling stocks, a piece of real estate, or the vintage baseball card collection, understanding capital gains taxes can help you make smarter decisions and keep more money in your pocket. At its core, a capital gain is the profit made from the sale of an investment or real estate. If you buy an asset for $1,000 and later sell it for $1,500, you have a capital gain of $500. These gains are recognized or categorized in 2 ways. The first could be short-term capital gains, which are profits from assets held for a year or less. They are considered short-term. They are generally taxed at your ordinary income tax rate. Long-term capital gains. These are profits from assets held for more than a year and are labeled long-term. They benefit from a lower tax rate, which can vary based on your taxable income and filing status. The importance of planning. So some may ask, why does this distinction between short-term and long-term matter? That is because the tax implications can be substantial. For many taxpayers, long-term capital gains are taxed at a more favorable rate, as I mentioned earlier, than short-term gains. Thus, holding onto an asset for just a bit longer, say 13 months instead of 11, could lead to a significantly lower tax bill. Of course, like many tax rules, there are exceptions and exclusions. There are specific cases in which the capital gains tax has exemptions or special rules. A notable exemption is the sale of your primary residence. If you meet certain requirements, you can exclude up to $250,000 of gains from taxes, and that's $500,000 for married couples filing jointly. However, this does not apply to rental properties or second homes, vacation homes. Some strategies to minimize capital gains. So first one would be wait it out. So as mentioned, holding on to investments for more than a year moves them into the long-term category, often resulting in lower taxes. Tax loss harvesting. So this involves selling securities at a loss to offset capital gains in other areas. It can be a strategic move, especially in a down market. Gifting assets. So instead of selling assets, consider gifting. While there are limits, this can be a way to transfer value or wealth without triggering capital gains taxes. Maximizing tax advantaged accounts. So unlike accounts like 401ks or IRAs where investments grow tax-free or deferred. Stay updated. Tax laws can change. Ensure you're up to date with the latest rules and rates, and that's where you can rely on your tax advisors and Tronconi Sierra Associates. Be proactive. While taxes are inevitable, the weight of their impact is to an extent under your control. By understanding the nuances of capital gains taxes and making informed decisions, you can optimize your financial outcomes. Remember, it's not just about what you make, but what you keep. A proactive approach today can lead to fruitful savings tomorrow.
Great, thank you everybody and all our wonderful presenters and experts. I hope you guys enjoyed our New Year's theme and countdown of this. We are going to turn it over to Lisa and Kevin for any Q&A. Again, in your toolbar to the right-hand side, you should have an option to answer some questions in. If you want to do that, you can go ahead. And also just a reminder, I will be sending the presentation out via email either later today or tomorrow. And it will include the recorded session and also a copy of the slides. So if you missed anything or was having any audio issues, you can catch it then. So again, if you have any questions, pop them in there. We'll get them answered. And I'll turn it over to Kevin and Lisa to answer one of them that has come in.
Hi guys, thanks for joining us today. We do only have one question in our questionnaire right now. More than welcome to add more as you think of some. One that we have right now revolves around energy credits. Currently, there hasn't been anything stated that these are going to change much for 2025. And the question relates to if they decide to change it partway through the year, are they going to allow these credits or deductions to be for when you purchase them, or are they just going to retroactively change it for the entire year? It's hard to tell if that's actually going to happen or not in the first place. And of course, with every tax law they come out with, it's always different. But what I've seen in the past with other credits that relate to this category for autos, they typically have a date in which they make this this tax law in place or put in place, but then they will allow for that credit for before that date and then disallow it for after that date. So it's important to keep that receipt or invoice. So when you tell your accountant that you made a change on your home, they may ask, well, when did you make that change? Did you make it before this date? Because that's great, you're allowed to credit, but after that date, not so lucky. So, so I can't really answer the question, but that's my best guess at this point of what may happen. We'll just have to hold and wait for right now. Any other questions here?
Looks like Lori had 2 questions that she popped in there.
Perfect. All right, from Lori, what forms would one need for digital assets? So it all, at least
Really just, you know, reports that are available from the asset holder, anything that's really going to show us the information we need for the tax return presentation. Typically, you may or may not get a 1099-B from those transactions, but something that does show the dates of the transactions, the detail of the sales proceeds, and the gain or loss. So really, we'll take anything and we'll take a look through it and decide if that's what we need. Typically, you can download those reports right from the asset holder for the year-to-date, on a year-to-date basis.
So also Lori asked another question here, which is a good one. How long is business loss carried forwards allowed for 2024? So if you have a business loss that's created in 2024, there's no ability to carry it back at this point, but you can carry it forward indefinitely. The rule used to be you could carry it back a couple years and then carry it forward 20, and then it would expire if it was never utilized. Now they changed that back after the start of TCJA in 2018. There was a pause period during COVID, but then that's now been placed back in service here for the last 2 or 3 years now. So to answer your question, it will carry forward indefinitely unless you utilize it.
Great. It looks like Robert put a question in there about beneficial ownership information reporting.
Okay, according to BOI, are S corps still required to report? Currently, right now, Robert, every operating entity that's, well, I guess, what do you want to say here?
Well, there's a lot going on in BOI right
Yeah.
now.
That's kind of where I'm at too.
Very fluid answer.
Yeah.
We can actually send out some updated information on this. It actually has changed quite a bit in the past week. So to ensure we're going to give you the right information, maybe we can just shoot that out in addition to the presentation information. So
That'd be great. Also,
not all S corps are required to report. There are exemptions. So we hate to just give a blanket yes or no answer. There's a long list. I think it's 25 potential exemptions there. So let's get that to you and hold tight, because there is going to be some flexibility with whether or not the reporting is going to be required still before the end of the year. As of right now, again, it is very fluid. So we'll give you the latest on that in following the presentation.
when I send the email out to everybody, we do have 2 blog posts on it. One was the original one, and then one was with the update. So I'll include both of those links for everybody on the BOI. And it looks like Timothy has a question.
Okay, so Timothy, one advantage grandparents do have is to take advantage of the, depending on the state you're filing in. So let's say, for example, that's New York. As a couple filing jointly, you do get to deduct up to $10,000 of those contributions to the account. So if you are a single individual, that limitation is $5,000. There are certain states that have no limitations. I just had a client I did some tax planning for last week, where I think it was South Carolina, and there is no limitation to those deductions. So I believe we do have some out-of-state attendees today. So let us know if you'd like us to check into those particular states' limitations for you.
There's one important factor here. I see this quite often, where there's a grandparent who's contributing into their grandchildren's 529 plan. It is important to know that you have to have that plan in your name. If it's in your son or daughter's name and you're just making the contribution to the plan, it is not a deductible item for you, and you will receive an automatic notice from your state if that is the case. So just make sure, if you are going to contribute it to your granddaughter's or grandson's plan, make sure it's in your name, or it would be possibly a gifting opportunity to your son or daughter, and then they can make the contribution themselves.
Great, Lori, we will get back to you regarding specifically Illinois. So either Lisa or Kevin will reach out to you on that directly. We're running early today. We didn't take our full hour, but again, hopefully you enjoyed our presentation today. And again, if you have any questions, you can email Lisa or Kevin directly. Feel free to call us. And again, you will receive the survey in the end. You can also note in there if you would like a follow-up call or email from them. Thank you again for joining us today, and have a great holiday season and ringing in 2025. Thanks, everyone.
Thank you, everybody. Have a great day.